Hello everyone. So today we'll be solving one problem on computation of your PGBP income. So the problem number 4, which is shared with you in the PDF, we will be trying to find a solution for the same. If you look at this problem, the profit and loss account of Mr. B is given to us in the question. So based on this profit and loss account, we are supposed to find out what is the taxable income of Mr. B's business according to the rules of IT Act. So first of all, we start off our problem with net profit as per the profit and loss account. So you have two columns. One is your particulars. The next one is your amount. So you start the problem with net profit as per P&L account. And if you can look at the question, the net profit that is given to us in the question is 88,000. So we will be writing that 88,000. Next step is we will be deducting, or I'm sorry, we will be adding inadmissible expenses debited to P&L account, which means that if you look at the debit side of the profit and loss account, you can find there are a lot of expenses which are debited into this P&L account. We will have to check if all these items which are debited to profit and loss account, is it allowed, or in other words, is it admissible or inadmissible according to IT Act. So you will be picking each item. The first item that you have here is salary. So you will have to decide whether salary is admissible or inadmissible. If it is allowed or if it is admissible, you ignore it. You don't use it for calculation purpose. But if it is inadmissible, you will have to add it back. So to our net profit, if any expenses which are debited on the debit side of, or debited to the profit and loss account, if you think that these expenses are not allowed according to the Income Tax Act, in that case, such expenses will have to be added back. So you will have to be looking at each item and decide whether it is admissible, or in other words, whether it is allowed or disallowed according to Income Tax Act. Now, the rule is pretty simple. Any expenses which are genuinely not related to the business are disallowed. Only items which are exclusively related to the business will be allowed. The first item that we have here is salary. So if you look at it from a business point of view, payment of salaries to the employee is a major expense related to the business, and it is a part and parcel of the business. So it will be allowed. Salaries is genuinely connected to the business, so it will be allowed. The next one is office expense. Of course, a business will have an office, and expenses related to these office will also be allowed. But always remember to check the additional information, because that will give us more insight on what are these office expenses related to. So if you look at this, there is nothing related to office expense, but there is an item related to salaries which is given to us in additional information. So the total salary that they have shown in the profit and loss account is 3,30,000. This 3,30,000 actually includes a salary that this person has paid to some worker at his house. So this purely is a personal expense which they are showing in the business profit and loss account. So this 12,000 being the personal expense, since it is shown in the business books, it is disallowed. And if it is disallowed, it means that you will have to add it. So salary paid to worker at home, and the amount is 12,000 rupees. The next item that we have over here is office expense. Like I said, it is allowed. The next one that we have here is depreciation. Now remember, Regarding depreciation, there is no information that is given to us in the additional information, except that they have told that depreciation or the total depreciation includes 6,000, which includes unabsorbed depreciation of earlier year. So nothing else is given. So we will assume that whatever depreciation has been shown is allowed. So since there is no information regarding what is the amount of allowable depreciation, that information is missing in the additional information. So we will assume that whatever depreciation is shown in the profit and loss account is allowed, and we will just ignore it. The next one is GST. The payment of GST is also allowed because in the normal course of business, you would require raw materials. GST will be paid for all the materials that you use for production. So GST, payment of GST is a part and parcel of business. So it is allowed. But see to it that it will be allowed only if GST is actually paid. If GST amount is due or if GST amount is pending or yet to be paid, then it will not be allowed. And if it is not allowed, you will have to add it. But since here they have just told that GST, we are assuming that it's already paid. And if it is paid, it is allowed. It becomes disallowed only if it is not paid. Next one is legal expense. In the normal course of business, there would definitely be legal expense, but we will have to look at the additional load. So legal expense, it includes 2,000 rupees, which you have paid to the lawyer, and that too, it is related to your personal work. So some personal expenses of yours, you have shown it in your business expense. So this legal expense of 2,000 rupees is not allowed, or it is disallowed or inadmissible, which means you will have to add it. So legal expense of 2,000, you will add it. The next item that we have over here is purchase of patent right. So you know that asset can be classified into tangible asset and intangible asset. Tangible assets are your land, building, furniture, machinery, and intangible assets are your patents, trademarks, copyrights, technical know-how. All of these are your intangible asset. So whenever you purchase these tangible or intangible asset, which I just mentioned earlier, all of these are capital expenditure. And according to Income Tax Act, every capital expenditure is disallowed, which means that you will have to add whatever price you have paid for purchasing land, building, machinery, or your intangible asset like your patents, copyrights, trademarks. All of these are capital expenditure. So whatever amount you have spent on the capital expenditure is disallowed, and you will have to add it back. So the third item that is disallowed and which we'll be adding is purchase of patent rights. Patent rights, and the amount is 24,000. The amount is 24,000. The next item that we have over here is repairs. So we are assuming repairs are revenue expenditure. So in this case, repairs are allowed. Maybe repairs to the building or any repairs as such, it's a revenue expenditure and hence it will be allowed. Next one is provision for bad debts. Please remember, any provision or reserve is strictly disallowed according to the IT Act. So the minute you see the word provision for bad debts, reserve for bad debts, provision for GST, it's all disallowed. The Income Tax Department will not let you show these provision as expenses. So these are disallowed. So the fourth item which is disallowed and hence that should be added is provision for bad debts. and the amount is 6,000. The amount is 6,000. The next one is donation. Donation strictly is disallowed. So donation is nowhere connected to the business. This person doing this business might be a very good human being and he wants to do some donation. So he's donated some money and he showed it as his business expense. But according to Income Tax Act, donation cannot be shown as expense or it is disallowed expenses. So in this case, okay. So if you look at this, in this case, the donation is disallowed and hence you will be adding it back and the amount of donation is 4,000 rupees. And the next thing or the next item that you have, the last one you have is general expense. Look if you have anything related to general expense. If you look at point number 4, so point number 4 states that general expense, it includes 28,000 as contribution to staff welfare fund. Like I told you, even in the class, there are staff welfare fund and staff welfare expense. Staff welfare fund is acceptable. I'm sorry, staff welfare expense is allowed or it is admissible. But staff welfare fund is not recognized and hence it is disallowed. So you might end up getting confused between two items. One is staff welfare fund and staff welfare expense. Staff welfare fund is not allowed, well, staff welfare expense is allowed. So this general expense, as you can see, this general expense of 24,000 is actually allowed. We are assuming that this general expense is completely related to business. But this 24,000 includes 8,000 which you have contributed to staff welfare fund. And whatever you contribute to staff welfare fund is strictly disallowed. So we will be writing contribution to staff welfare fund and the amount is 8,000 which is disallowed. So we're done with all the items on the debit side of the profit and loss account. So we'll just total this up. The total of this will sum up to 70,000. So the next thing that we are supposed to do is, the next heading is less admissible expenses not debited to P&L account. This is where you show your depreciation, which is allowed, debited to P&L account. So this is the point where you show your depreciation. So the first one related to your depreciation would be, the first point related to your depreciation will be, they have told you that there was an unabsorbed depreciation of earlier years, but it is not recorded. So any unabsorbed depreciation of previous year you have, it is allowed. So you can deduct it, unabsorbed depreciation. So the amount will sum up to 6,000 rupees. And the next one, nothing, if you can see, you have purchased the capital asset. The capital asset that you have purchased is patent, an intangible asset. Sorry, there has been a capital expenditure, and this capital expenditure is related to the purchase of patent. But nothing is mentioned about the depreciation of this patent. Please remember, in your profit and loss account, if you have any capital expenditure regarding purchase of any asset, you should be calculating depreciation on those assets, whether it's given to you in the additional information or not. For whatever capital asset, I'm sorry, for whatever asset you have purchased in the year, you will have to calculate depreciation, whether it's mentioned to you in additional information or not. So we will be calculating depreciation on patent. It's not mentioned to us. They have not specifically told in additional information anything about calculation of depreciation on patent. But please remember that you will have to calculate your depreciation on capital expenditure of the asset. Okay, depreciation on patent. Now, how do you calculate it? You take the value of patent. The value of patent is 24,000. So we will be writing 24,000 into the rate of depreciation on patent is 25%. You will have to remember the rate of depreciation for different asset. Please watch the depreciation video to know more about this. You will have to calculate 25% depreciation. Next important thing which you have to keep in mind while calculating depreciation is the date on which it was acquired. Patent was acquired on 15th of January. From 15th of January till 31st of March, you will have to calculate the number of days. If the number of days is more than 180 days, then you can stop your calculation here and you can directly calculate depreciation. But if it is less than 180 days, only half of the amount can be charged as depreciation. And repeat it, when you're calculating depreciation, you will have to calculate the number of days the asset was used. If the asset was used for more than 180 days, you can use the entire percentage or you can claim depreciation on the entire percentage. But if it is used for less than 180 days, only half of 25% can be claimed as depreciation. So 180 days is like a divider. If you have used the asset for less than 180 days, only half the percentage can be claimed as depreciation. If it is used for more than 180 days, you can use or you can claim the entire rate as depreciation. So in this case, it will sum up to 6,000 rupees and the total will be 12,000. So once you're done with this items on the debit side, you immediately write this admissible expense not debited to P&L account where you show your calculation related to your depreciation. The last item that we have over here is non-business or non-admissible income credited to P&L account. So if you look at this, we have only seen the debit side of the profit and loss account, but we have not seen the credit side of the profit and loss account. Again, on the credit side of the profit and loss account, we will be looking at each item and deciding whether it's admissible or not. If it is admissible, we leave it, we don't do anything with it or not use it for calculation. But if it is not admissible, in that case, we will be deducting it because these are income. In the above case, we added it because these are all your expenses. But in this case, on the related to credit side, we will be deducting it because these are your income. So gross profit not considered, bad debts recovered. Now, again, there is some information related to bad debts. Out of bad debts recovered, rupees 8,000 were allowed as deduction last year, which means that this is the amount you have recovered from bad debts, 20,000. Out of this 20,000, 8,000 was already deducted last year. So the amount which was already deducted last year or which was already allowed last year, you can't show it again. 20,000 is the amount of bad debts you have recovered. Out of this 20,000, last year you have already deducted 8,000 rupees. So this year when you're deducting, it is going to be bad debts recovered. Bad debts recovered. 20,000 is a total amount. 8,000 you have already shown it as deduction last year. So the remaining amount is 12,000, which you will be deducting it for this year. The next one is Dividend is nowhere related to your business income. It will be taxable under the head income from other source. So it is not related to your business. So that will again be added. So if you can see, dividends are added because it's not your business income. You have invested your money in some investment and you've got the return on that investment in the form of dividend. So it is nowhere related to your business, hence you will be adding the same. The next one that we have over here in the question is, the next item that we have in the question is rent from house property. So it will be taxable under the head income from house property and not here. So any rent you receive from house property will be taxable under income from house property and not PGBP. So it is not admissible. That's why we are deducting here. So rent from house property, rent house property, and the amount, as you can see, is 18,000. The amount, as you can see, is 18,000. The next one that we have, the commission and brokerage and sundry receipt. These three are related to the business itself. During the normal course of business, you give commission, you give brokerage, you receive commission, you receive brokerage. There would be some small incomes which you would receive. So these are all business income. If it is related to business, you ignore it. And the last one, share of income from HUF, is not a business income. It is not admissible. An income which is not admissible, you will be deducting it. So share of income from HUF, and it will sum up to 6,000 rupees. So the total of this will be 54,000. So from 88,000 to 88,000, you will be adding 70,000, deducting 12,000, and also deducting 54,000. What you get is your taxable income from business. Okay, what you get becomes your taxable income from business. So that is equal to 1,04,000. So that's all your problem is all about. An important 14 marks problem. Kindly go through it. And if you have any doubts, get back to me. Thank you.